This is Charting Wealth, the book, Chapter 4, Timeframes. When you look at the market, what are you actually seeing? It's price movement within some moment of time. It may be that the market's the S&P 500, the NASDAQ 100. It may be what they did in the course of a year, up 50%, down 1/3. It could be gold and what it did last Friday, or what bonds did last week. Time frames are important because they give us the ability to quantify price movement during a certain period, thereby allowing us to determine what actually occurred. Time frames can become more helpful when we combine them and look at the price movement of a single equity, ETF, etc., in multiple movements of time. Time frames can be seen as waves of price flow. The larger the time frame, the bigger the wave, and typically the bigger the wave, the more power it has. Why? Because bigger waves, that is larger time frames, are made up of smaller waves. Think about it. It takes 12 5-minute time frames to make one 60-minute time frame. The inertia of the larger frame tends to move the smaller charts in its direction. Well, not really, but that's the way it looks, until, of course, those smaller charts stack up enough energy to change the flow in another direction. We like to say the default with time frames is, all things being equal, the market moves in the direction of the larger time frame. Now, when charting the market, you can use any time frame you wish. Through tried and true efforts on our part, we have chosen to use the weekly, the 2-day, and the 4-hour time frames. Why? Well, we've found that these time frames working together provide us with the best trends and entry points for making trading and investing decisions, and of course, in the end, for hopefully making successful trades. Please note, we are not day traders, and these are not day trader charts or time frames. Instead, we look to use trends on our weekly and 2-day charts, and then the half-day chart as an entry point into those trends. We are continually cognizant of our weekly chart. Ideally, we want to see the trend on the 2-day chart also moving in the direction of the weekly chart, but such an arrangement's not always required. Why? At some point, the weekly chart will roll over in the opposite direction, and we will wish to enter into positions prior to that event occurring. It can be dangerous, but with experimentation, it can work very well. There are many time frames, and as you learn to read the charts, feel free to explore all of them. There is a trick, and never forget it. The market is always changing. Be willing to learn our method, but don't ever be afraid to experiment. It costs you nothing to experiment and make multiple virtual trades and investments all the time. You can also experiment with other exchange-traded funds, other indexes, and every stock out there. The bottom line is this: be able to accurately read the charts and predict future movements. Does that sound correct? It's not. It's not predicting future movements, but jumping onto trends. That's what we do. For any stock technique to work, it has to be successful. Duh. That prior sentence is merely a statement of the obvious, but you would not believe the number of people who, in spite of all reason, commit themselves to ideas, beliefs, and systems that are outmoded and don't work. Above all else, you must have a system that works and assists you in accurately determining if the equity being analyzed will go up, down, or sideways. It's just that simple and straightforward. Now, our system of using time frames and charts is just your starting point. It's not your ending point. But take our knowledge, grow with it, learn it, and modify it in your own system. Mutation, adaptation, and evolution are not dirty words here. They are all encouraged as long as they work. Thank you so much, my friends, for being with us. If you have questions or comments on this chapter, we would love to hear from you as we continue to put this book together. God bless. All the best from the whole team here at chartingwealth.com.